Make it live.
Yes,
Make it
yes,
live.
sir. We are live.
No, I am seeing in my pre-live. It is there. Right. Okay.
Sir,
Please
we
start.
are live. Yeah. Uh, Welcome everyone to the webinar today organized by the BFSI board. Today, all are aware of the importance of insurance in our life. So BFSI board, as it is celebrating the insurance month, have also tried to put forward the importance of insurance and its reporting. The aim to, as today's program goes on IFRS 17, the aim of IFRS 17 is to standardize insurance accounting globally to improve comparability and increase transparency, and to provide users of accounts with the information they need to meaningfully understand the insured's financial position, performance, and risk exposure. Today, we have amongst us Anjani Kumar Khaitan, who is a renowned professional and working based on IFRS, Ind AS, and US GAAP. We welcome you, sir, to the program, who
Thank
who
you.
will be the main speaker on today's topic. We have amongst us our chairman of BFSI board, CMA Chittaranjan Chattopadhyay, sir. Sir, welcome you to this program. To start with, we will go with our institute anthem and followed by CMA Chittaranjan sir's briefing.
Namaskar. Very good evening to you all. Today is a great occasion for us. For we are celebrating Insurance Month. This is the first episode of this particular Insurance Month, where one of the versatile personality on the IFRS gap, US gap, and Indian accounting standard. Not only that, he's carrying a very checkered career in his life as a professional. CMA Anjani Kumar Khaitan. I welcome you, Mr. Khaitan, in this particular program.
Thank you, sir.
And this we have with us our entire team of BFSI board, comprising of CMA Dr. Aditi Dasgupta, CMA Debabrata Das, and other members of the board. Of course, our HOD, Secretary CMA Dibyendu Roy. He is engaged in other program in Nasik, but he's the actually architect of all these programs. Today we are having these programs on IFRS 17. Let me just introduce you with IFRS 17, because the nitty-gritty will be dealt by our honorable speaker. What we understand from the BFSI board, why we have just crystallized this thought on this IFRS 17 for this program, that I should establish before you. IFRS 17 establishes the principles for the recognition, measurement, presentations, and disclosure of insurance contracts within the scope of standard, as you know. And you also know the objective of IFRS 17 is to ensure that an entity provides relevant information that faithfully represents those contracts. This information gives a basis for users of financial statements to assess the effect that insurance contracts have on the entity's financial positions, financial performance, and cash flows. Friends, you know, IFRS 17 was issued in May 2017 and applies to annual reporting periods beginning on or after 1st January 2023. The primary objective of IFRS 17 is to provide transparent and relevant information about an entity's insurance contracts to help users of financial statements understand the amount, timing, and uncertainty of future cash flows arising from those contracts. It replaces the existing standards and that IFRS 4, as you know, which allowed for a variety of different accounting practices among insurance companies. There are many features of this IFRS 17. I will be not going to the details because all will be dealt, I think, by our honorable speaker. But let me tell you one thing, that these key features of IFRS 17, which actually improved measurement of insurance contracts, recognition of profit, contract groups, disclosure requirements, and of course, definitely IFRS 17 is designed to provide a more comprehensive and transparent view of insurance contracts and the financial performance of insurance companies. IFRS 17 represents a significant change in the accounting of insurance contracts, and its implementation is posing challenge for insurance companies. This challenge, that's a very interesting that after IFRS 17, these challenges are for the insurance companies: the complexity, systems and process changes, then data and information management, model risk. This is another area where IFRS 17 requires companies to use actuarial models to estimate the expected cash flows from insurance contracts. And this creates the model risk, as the accuracy of the financial result will depend on the accuracy of the underlying models. And insurance will need to carefully manage this risk and ensure that their models are robust and transparent. And also cost of implementation. This is a very important issue where I think the CMS have got a very great role to play. And time and resources, where again the resource utilizations and times, which has been taken by this IFRS 17, a significant amount of time and resources for effective implementation until now, and there is still a majority of work left to be done actually. Therefore, these challenges are there, but while these challenges describe whatever we have told, it is important to note that this new standard also represents exciting opportunities. What are those opportunities? We have learned improved collaborations, expose weakness in your processes, and opportunity to automate, and better insights into business. And definitely the implementation of IFRS 17 enables new insights into the business, especially on profitability. Again, the granularity of data collected empowers a more comprehensive understanding of the risks and opportunities present in the business, which can be used to inform strategic decision making. Friends, the CMAs have got a great role to play in the insurance sector so far as the managing of costs, managing of expenses are concerned. Definitely, this IFRS 17 will be giving us it will throw us a light how the CMAs can more and more, they can really help the insurance industry to grow effectively with a cost-effective manner, and the resource optimizations and cost mapping. We are holding this program today, and we will be having another program on 21st, which would be addressed by the CMD of National Insurance Company, Madam Rajeshwari Singh Muni. Then the NIA Director, CMA Dr. Tarun Agarwal, and ex-Director of NIA and ex-Chairman and Managing Director of New India Assurance, CMA G. Srinivasan. And we will be having two speakers, one CMA Ashok Kumar Jain, who is also in the insurance industry for a long time, and CMA SP Padhi, who is a practicing consultant for the insurance companies. So therefore, we are holding this program just to for your learning, relearning, and unlearning, of course. And I'm sure these sort of programs will help you. And I'm again thankful to CA Anjani Kumar Khitan, who has provided his time, who has brought his appearance here In fact, I am really grateful to him because he's a very busy personality. But considering the fact that the insurance coverage, the protection gap of the country is more than 93%, therefore we require to sensitize all the members of the CMA fraternity and all the professionals how to reduce the gap, because it's a crying need of the country. As Honorable Prime Minister has already given a clarion call that Dikshit Bharat by 2047, and I think 2047, when we are sure with the help of our IRDI is going to celebrate its 25th in the next year. Therefore, we are with IRDI. We shall be definitely taking this matter forward with the help of all the CMAs in India and globally, so that the insurance sector more and more become more and more inclusive. It will be the inclusivity of the insurance sector enhances amongst the Indian citizen. With this, I am again welcome you all for this excellent session today. Thank you.
Should I share my screen, sir, now?
Yeah, please start.
Sir,
Okay.
Now, but before that, we want to introduce you.
yes, sir. I will be introducing our speaker to all the members present here. Sir, we welcome you to today's webinar once again. CMA Anjani Kumar Khaitan is an associate member of the Institute of Cost Accountants of India. With about 26 years in post-qualification experience in leadership roles with renowned business organizations, both in industry and one of the big four accounting firm. In addition, our speaker is also an associate member of the Institute of Chartered Accountants of India and a member of ICSI. Anjani Kumar Khaitan is currently based out in Bangalore and is also working as a regional head in finance in a multinational company. The core competencies of our speaker include corporate accounting, including compliance with the US GAAP, IFRS and Ind AS, finance, treasury, transfer pricing, domestic and international taxation. Anjani is also a visiting faculty in ICAI's training coaching on Ind AS for about 9 years, including that on IFRS 17 or the proposed Ind AS 117 on insurance contract. He is also in panel for shortlisted faculties by the ICAI on goods and services tax and also holds a diploma in international taxation issued by ICAI. Our speaker has also contributed articles in professional magazines like Chartered Accounts, Chartered Secretary, and is also associated with activities of ICAI like review of study material and case studies, etc. Sir, we welcome you once again to our program. We are really grateful to have you amongst us today. Hope our members will be benefited from this today's session. Sir, over to you. You can start.
Thank you, sir. Thank you, Chittaranjan ji, and thank you, Debrata sir. Let me share my screen and just if you can confirm if this is visible to everyone. Is the screen visible now? My PPT is visible?
Not yet.
No, sir.
Okay. Just see this one now. Okay, I'll stop 1 minute. I'll try one more time.
Yes, it's visible now.
It's visible now? Okay.
Right.
Okay, so thank you everyone and good evening all the members. So we have almost 1.5 hour, 1 hour 45 minutes to talk about this topic. Okay, before we get into the topic, this by far represents one of the most complicated piece of accounting ever produced by an accounting body. Okay, so our endeavor over the next 1.5 hour or so would be to just introduce you to the basic aspects of what this insurance contract accounting is all about. And of course, we will see if there are any specific questions. I will try my best to address those questions as we go along. So with that background, let us start the session. And some of the key discussion points which we are going to cover. The first thing is we will introduce you to this topic of what this IFRS 17 is all about. What is the background to this standard? What is the objectives with which this standard is written? What it seeks to achieve? Why this new standard was brought on the statute books? Why aspect of this new standard? Some of the key features which was alluded to by Chittaranjan sir, we will look at all of that. Further, we will be looking at what is changing under the new standard. We already have an existing standard, IFRS 4, which deals with the insurance contract accounting. So by this new standard, what is changing? What changes will be brought out by this standard? What has been the journey? As you might be aware of, that this standard has taken decades to eventually see the light of the day, right? So what is the journey of this standard? What are the contracts which are scoped in? What is covered when we talk about accounting for IFRS 17? What is scoped in? What is scoped out? What is not covered within this standard? What is covered within this standard? And the various measurement models which are being talked about. So we will just touch upon the various models of measurement which this standard talks about, and the possible transition approaches which the standard deals with. There are 3 of them. So we will see. This is what our objective would be to cover over the next 1.5 hours or so. Okay. So starting with the introduction and background. So first thing first, that this standard IFRS 17 actually represents the first truly international and a comprehensive accounting standards when it comes to insurance contract accounting. Why so? Because even now, as I mentioned, we already have IFRS 4 as an existing accounting standard. But then the difference is that IFRS 4 was always intended to be an interim standard pending finalization of a full-blown standard. And this standard would replace IFRS 4, as I said, which was always sought to be an interim standard. And this IFRS 4, which is the existing standard, actually resulted in a lot of divergent practices of accounting of insurance contracts. The reason is because this IFRS 4 did not prescribe for any measurement techniques per se for insurance contracts. Instead, this standard allowed companies to use their local accounting gap or local accounting requirements in terms of accounting for the insurance contract. And therefore, each country would follow their own mechanism in accounting for the insurance contracts. And because of which, there was a lot of diversity and divergent practices. You will also notice that because of this lacuna, an Indian insurance company, which may have, let us say, their own group companies in various other countries. Okay, so for example, an Indian company, insurance company, has their counterpart or their sister concerns, let's say in Ghana, or so for example in Europe or in US. They may be following different accounting practices, even if they are within the same group. So therefore, IFRS 4 actually led to the problem of diversity, and that diversity in a way is expected to be reduced or eliminated by, not fully eliminated, but I would say it is expected to be reduced by IFRS 17. So therefore, it is important also to note that IFRS 17 does not only apply to insurance companies. It rather applies to any entity, I repeat, any entity which has issued a contract which meets the definition of insurance contract, thereby meaning that IFRS 17 can typically also apply to a normal company or a manufacturing company or any other company in the not necessarily in insurance industry, if such entity have issued a contract which meets the definition of insurance contract. Of course, primarily still this IFRS 17 will impact companies within insurance sector. But that need not be the case. And that is exactly what is mentioned here, that IFRS 17 applies to all entities, not just the insurance companies. Of course, this is expected to get the biggest impact on the companies within the insurance sector. But then any other company can also equally get impacted by this particular standard. Okay. And as Chitranjanji was alluding to here, this standard IFRS 17 provides useful information about the profitability of insurance contract. And this is one of the key characteristics of this particular standard. And also it will bring increased transparency in the financial information which is produced by those who are issuing insurance contract. Just let me see if if the link works. I'll just see 1 minute. If the link works, I'll show it to you, a sample of how does that work. 1 second, let us the mouse. I don't know, somehow the links are not working. There was can you just let me know how this because I'm using Teams for the first time from presentation. Basically, we all use Zoom. So how do I bring the present okay, pointer is here. Okay, 1 second. Here is all. I don't know, the pointer is not there here. It's like, okay, annotate option is there. So hopefully it will be here. Okay. I don't know, it's not happening. Anyway, so maybe at the end, I will show it to you. Oh, it is here, it looks like. Yeah, it has come. Okay. No. Okay, no problem. So I will demonstrate to you and show it to you basically that this standard brings in more useful information. Basically, what happens that as an insurer, you have two sources of profitability. One, which is purely profitability coming from the underwriting business. And secondly, one which is coming from the finance income. So the standard requires the way the P&L statement is produced, basically both the underwriting business related the profitability and the investment related activity need to be segregated. That should be in two different sections. And therefore, when we say that this provides more information, this standard would provide more useful information. I don't know why this is picking up. Okay, hopefully it should. Okay, more useful information on the profitability of the insurance contract, because it will require you to split the profitabilities or the P&L statement into two parts. One which is related to the pure underwriting business, and the other which is related to the investment activities. And therefore, the transparency of the financial information is expected to be much more than what we otherwise see today in case of the IFRS 4. And therefore, also you should be aware that this standard requires consistent accounting of all insurance contracts. Why so? Because this standard introduces 3 specific accounting measurement models. That is something which we will see as we go along. There is something called building blocks approach or the general measurement approach, or the other 2 models which are for short-term insurance contract, or the ones which are the participating contracts. We will see that. But then the principles underlying these measurement models are pretty much similar. Of course, there will be certain tweaks which are available for the other two types of these measurement models, which are a derivation or a slight modification of the general measurement model. Okay, this is what we need to be aware of. Now, the next question is why new standard? The reason why this new standard, as I already kind of indicated, the problem which was underlying in IFRS 4, the existing standard, led to development of the new standard, which means the problem which we were facing under IFRS 4 is something which is sought to be addressed by this standard. So for example, comparability. As I mentioned, IFRS 4 did not prescribe any measurement of the insurance contracts, and because of which, because there was no specific measurement prescribed under IFRS 4, there was lot of divergence. Only national gaps was something which was allowed, and that even within, not only between multiple insurance companies, but within the same geography, also the same insurance company working in various geographies, they also had various accounting practices which they were adhering to, and because of which there was intercompany comparison was becoming very, very difficult. Now with the introduction of IFRS 17, what will happen? All of these something which will be streamlined, because depending upon the nature of the insurance contract, one of the three models which we will see at a later part of our discussion today, one of those three models is something one need to apply. And therefore, there will be far more better comparability and consistency between various companies. Also, what this standard requires, especially when you will look at the general measurement model, what that model tells you is that when you are measuring the insurance contract, you got to look at few things. You have to look at, for a group of insurance contracts, what is your expected inflows? Which means, let's say, for example, the premium, what you are going to get. Then what to service these contracts, what are your expected outflows? And as we know, because the insurance contracts could be a long drawn, relatively long period contract ranging over, let's say, 5, 10, 20 years. And therefore, the standard requires that these cash flows need to be discounted to take care of the time value of money. And apart from that, there is one more specific adjustment which needs to be done, which is called risk adjustment. This is a specific adjustment which is required when you are measuring your insurance contract liabilities, just because the insurance company or the issuer of the insurance contract is actually taking the non-financial risk. And therefore, there is a specific requirement that when you are measuring the insurance contract, then you have to take a specific, you make a specific adjustment for the risk adjustment. And what is left over is your unearned profit. And this unearned profit is given a name called CSM, contractual service margin. So no part of this CSM, which is on day one, you can take it to revenue. So in my example, if your contract is for 5 years, and by doing all of these computation, as I will show you in one of the slides later also, if your unearned, if the group of insurance contract, by reference to the expected inflow, outflow, the discounting and the risk adjustment, it gives you an undiscounted, the unearned profit of 100. And if your insurance contract is for 5 years, assuming that the insurance contract services are equally provided over the 5-year period, basically this divided by 5, 20 rupees is what you will recognize as revenue in each of the 5 years. Thereby meaning that unlike perhaps in the current practice, cash flow based accounting cannot be done. It has to be done. So the profit will be recognized as you provide insurance contract services. We will see this that in next couple of slides as well. So some of the key features is that, as I already mentioned, that this IFRS 17 applies to insurance contracts and not to insurance companies per se, not to companies, but to contract. Thereby meaning that if a non-insurer, a company which is not in the insurance sector, if they issue an issue a contract which meets the definition of insurance contract, that also we will see, in the next couple of slides, then they are equally covered within the ambit of IFRS 17. So IFRS 17 applies to insurance contracts and not to companies per se, or the insurance companies per se. It is far more prescriptive than IFRS 4, as I told you, because there are measurement methodology. So the principles are given in the standard, and those principle forms the edifice of how an entity which has issued insurance contract need to account for those insurance contracts. And as I also mentioned that for this, the CSM, when you calculate the CSM, how CSM is calculated? CSM is calculated by first you estimate your inflows, outflows, then do the discounting and the risk adjustment. The leftover is your CSM. This is what it says here. Applying IFRS 17 entails complexity of forecasting. All of these you got to forecast. And not only you have to forecast at the beginning, you have to keep updating this forecast as you progress through the life of the contract. And therefore, forecasting of cash flows and calculating risk adjustment, this RA, what I mentioned, these are something which forms part and parcel of the way the accounting for insurance contracts is expected to happen under IFRS 17. And therefore, this standard, as we saw, it will help the users to have more useful and transparent information. As I also said, because the P&L will be split into two parts, where you have the underwriting business per se and the investment business or the investment activities. They need to be separated out. It will lead to more useful and transparent information to the users of the financial statement. Okay, and therefore it will give better information about the profitability of the insurance contracts. So just to reiterate, under IFRS 17, an entity would be required to measure insurance contracts at current value. As I mentioned, all of these projections, not only you will do at the beginning when the insurance contract is entered into, but at each periodic reporting, you need to update your assumptions, update your forecast. And therefore, these will always be at current value using the updated assumptions at each reporting period about the cash flows, these two elements, the discount rate, and the risk at each of the reporting period. Therefore, they will report estimated future payments to settle the incurred claims on a discounted basis. And when you use this discounting, the discount rate which you use should be characteristic of how your insurance cash flows are. So typically, if your insurance cash flows are illiquid over the period of the insurance, then the discount rate which you are using for discounting these should also reflect these the features, illiquidity feature of the cash flow characteristics of the insurance contract. So what is changing? First, information, these insurance obligations and the risks. We saw that this will now be based on updated information, thereby meaning that each reporting period you got to update your estimates. Then, as I already mentioned, the two key drivers of profitability. The two key drivers of profitability, which is your insurance service result and your investment results, they got to be separated because that's the format in which the P&L now need to be constructed under IFRS 15, that's IFRS 17. And insurance revenue should be on an earned basis. So you can't record everything on day one. Nothing would be recorded in profit on day one, and therefore your revenue is reported under IFRS 17 based on an earned basis. So for example, let us say if you have same example that your CSM, as I said, is a residual of your inflows plus outflows minus the discounting minus your risk adjustment. Minus or plus discounting, actually this will be plus. The effect will generally be plus, in terms of the discounting. But again, irrespective, plus or minus, depending upon how your cash flows are. So this CSM on day one, this represents unearned profit. And assume that if your insurance contract is for 3-year period, let's say you issued it in 2022 and the contract is for 3-year period. So that CSM, which is the residual by calculating this, is a liability. Basically, is an unearned profit, and this unearned profit will get released into each of those 3 years. So assuming, let us say if the CSM by using this formula is 90, Now that 90 will get split into these 3 years, that will released to P&L in these 3 years, depending upon how in each of these years insurance services are provided. So basically, the on an earned basis means this will link to how much you have earned out of the total profits, which is sitting as an unearned profit. Assuming in my example, if the equal insurance services are provided, in that case, this 90K will be recorded in the released in the profit as 30, 30, 30. And that's exactly what it says, that this liability for coverage, that is CSM, is released to P&L as the insurance contract services are provided, and nothing, no part of the profit which is booked on day one can be, no part of this CSM can be taken to profit on day one. It has to be taken over the period when the services are actually performed by the issuer of the insurance contract. So these are the improvements we have already seen. IFRS 17 will bring in improvement in terms of better consistency, better comparability, and increased transparency. And all of these were the issues which we had under the erstwhile IFRS 4. So essentially, all of these are expected to be addressed by IFRS 17 because it will lead to better consistency, better comparability, and increased transparency. I don't know whether the participants have the ability to interact with us. They are comfortable? They are following any chat? I don't know whether it is enabled. Can we get some input in case that is feasible from the members' perspective? Are they able to put some comment? Are they following any change which they want, or it looks all fine? Okay.
Sir, the attendees are can interact through our chat bots in the live event question answer sessions.
Okay, so maybe I would prefer, because see, it's like a monologue. So I would prefer if they are comfortable, they're liking it or whatever. If couple of inputs will help me understand whether it is going in the right direction. Okay, so I can see here. Okay. Okay, I see some member's name and it's going great. Okay, anonymous. Okay, you're doing great. Okay, thank you. So this gives me some indication that we are going in the right direction. Thank you. Okay, let's move further. So now, what is the objective? Objective of IFRS 17. What is it that it intends to achieve? Now, this is something also Chittaranjan had alluded to. Let us see what it is. So paragraph 1 of IFRS 17. If you see here, paragraph 1, this talks about the objective. So objective of IFRS 17 is to establish principle. It's a principle-based standard. It seeks to establish principle. For what? For these 4 things. Principle for recognition of insurance contract, measurement of insurance contract, disclosure underlying the insurance contract, and presentation. So this is what paragraph 1 talks about, what is the objective of this standard. And with that said, paragraph 1 continues to say, yes, this is my expectation. And to do that, IFRS 17 seeks to ensure that an entity provides relevant information which faithfully represents those insurance contracts. So what is the type of contract which you have issued? You should give information in such a way that those information are relevant to the users of the financial statement, and those information faithfully represent these insurance contracts. And the information so provided by the entity, you give such information which the users of the financial information make use of to understand, to assess the effect of these insurance contracts on the balance sheet, on the P&L, and on the cash flows. So the objective of this standard is these 4-fold objective, and more specifically to give information to the users of the financial statement in such a way so that the effect of issuing these insurance contracts on the balance sheet, P&L, and cash flow can be assessed by the users of the financial statements. That's the underlying objective of this standard. Now let us move to the journey. As I indicated, that this standard took decades to get finalized. Let us quickly see how the entire journey of IFRS 17 briefly has been. So it all started in 1997. We are into 2024. So in 1997, the contract or this particular project related to insurance contracts was started by the IASB. The today's what we know of the IASB. So this project was started then. And then because the project got started, they were expecting that a new standard will come up. And therefore, as I mentioned, IFRS 4 was issued, which was always intended to be an interim standard pending a new standard, full-blown standard IFRS 17 to be on the statute book. So in March 2004, still 20 years from now, we are in 2024. So almost 20 years back, this IFRS 4 was issued as an interim standard on insurance contract accounting. Now, after that, you will see that after this, for almost 3 years, there was a lull. Nothing happened after 2004, March 2004. The next major activity happened in May 2007 when a discussion paper related to IFRS 17 was issued by the International Accounting Body. Right? Thereafter, again, after 3 years, an exposure draft of the proposal was further issued. So it took almost 3 years from May 2007 to June 12, 2010 for the exposure draft of the proposal to get issued. And thereafter, again, you can see it took almost 3 years for exposure draft of the revised proposal. Now you can see it is not that there is any logic for these 2-3 years. The underlying requirement, why it took so much of time, because lot of stakeholders engagement and consultation happened during all of these 3 years. All these years, lot of stakeholders engagement, consultation, discussions happened, because this IFRS 17, as I mentioned, happens to be one of the most complicated piece of accounting. And also, you should understand, very colloquially it is often told that this IFRS 17 is actually an accounting for actuaries, not for accountants. Okay, but I mean, if you look at realistically, the way the actual implementation of IFRS 17 is expected to be, there has to be a very, very close coordination and teaming which is required between the accountants and the actuaries, because both are the key pillars to the successful implementation and ongoing activities with related to IFRS 17. None can work in silos. And if they do, it is doomed to be a failed project. And therefore, a successful implementation of IFRS 17 will always require a close coordination with both the accountants fraternity and the actuarial community. Okay, that's what. So this is what happened from 1997 to June of 2013. And thereafter what happened is you have, after 4 years, in 2017 of May, you first saw IFRS 17 being issued. So you can see from 1997 to May 2017, that was the time taken for the issue of IFRS 17. But it didn't stop here. Even after this standard was issued, then implementation became an issue. Because how do you implement the requirement of IFRS 17? And therefore, further stakeholders meetings started from May 2017 to June 2019. For 2 years, there were multiple TRG. TRG represents the Transitions Resource Group. This is a group within the international body IASB which help implement the standards. So there were a lot of stakeholders discussion happened between these 2 years, wherein the issues related to implementation got discussed, and because of which, even if IFRS 17 was issued in May, there was another exposure draft which was required to be issued to take care of the pointers which came during the TRG deliberation. And therefore, eventually after that, amendments were brought out. So this exposure draft led to a lot of amendments, and then in 1 year later, in July 2020, the final standard as we see today got published. So if you look at the history is from 1997 to July 2020, that was the final time which was taken for IFRS 17 to finally come on the statute book. So if you look at, as Chitranjanji also alluded to, globally, IFRS 17 is already effective from 1st of January 2023 last year. So assuming that if you are, let us say, a US company, okay? So for example, in our company in US, we have already implemented IFRS 17 starting 1st January 2013. So if this is your calendar year 2023, so this will be December 2023. This will be the first year, first full year when you will be presenting the financial statements as per IFRS 17. So the first IFRS 17 financial statement beginning 1st January 2013 with, so if you have calendar year 23 globally as the first year, the comparative has to be 1 year back, which is 2020 calendar year, with comparatives for calendar year 2022. So this is what you have to do, thereby meaning you have to prepare the opening balance sheet on 1st of January of the beginning of this period. And this is what would be the requirement. So what the standard tells you, if you look at the terminology used by the standard, it says that 1st January 2023, globally speaking, the day which is the beginning of the annual period. This is the annual period for which you will be coming out with the IFRS 17 financial statement for the first time. So beginning of this date is called date of initial application. Then first annual report under IFRS 17 will come out on 31st of December. And therefore, as I said, opening balance sheet you have to prepare on 1st of January beginning of the comparative period, which means 1st January 2022 would be the day when you would be preparing your opening balance sheet under IFRS 17. So that would be the date. 1st January 2022 would be the date when lot of other transition related, all the transition related adjustments, they need to be brought into the financial statement on the transition date, which will be 1st of January 2022 from the perspective of the global implementation of the standard IFRS 17. Of course, when in India, an equivalent standard Ind AS 117 comes into picture, we'll have to change these dates depending upon what is the actual regulatory requirement comes in based on when they are going to be implemented from an Indian perspective. But the logic would be exactly the same, that whichever period you do in India, that year would be your first year, then correspondingly the 1 year comparative, and whichever that period would be, beginning of that period would be the date when the transition need to be done. And as I mentioned, globally, IFRS 17 is already effective from 1st of January 2023. So with that said, now let us move to another area when I mentioned about what is the scope, what is covered within this standard, what is not covered within the standard is something which we'll now look at. So scope, what is in the scope? When we say certain contracts which are in the nature of insurance contracts as contemplated by IFRS 17, what are those contracts which is in the scope? Okay, once we see this, then we will look at what is outside this scope also. So let us first see what is in the scope. So what is covered under this accounting? 4 parts. There are 4 things. 1, 2, 3, 4. Paragraph 3 of IFRS 17 tells you that these 4 types of contracts are within the scope of IFRS 17, which means if you have issued these 4 categories of insurance contracts, you got to account for all of them under IFRS 17. What are those? First thing first, insurance contracts issued. So if an entity has issued an insurance contract to someone else, it's a policy holder. I am an entity which have issued a contract to this guy, and the contract which I have given is in the nature of an insurance contract as contemplated under IFRS 17, then this contract is covered within the scope of this standard. Let me do one thing, because perhaps the links are not working. Let me try one more time if link works. Else I will perhaps go to that slide itself. 1 second, let me see. Okay, if it doesn't work this way, let me go to here. This was the link. So what is an insurance contract? This is how the IFRS 17 defines what an insurance contract is. So in the context of IFRS 17, Appendix A to IFRS 17 defines what an insurance contract is. And it says, I have split this into bullets so that we have a better understanding. So in an insurance contract, this insurance contract is defined in Appendix A to IFRS 17 as a contract under which one party, the issuer, this guy, the issuer accepts significant insurance risk from another party, policyholder. This is the policyholder. So the issuer is accepting significant financial risk from the policyholder by agreeing to compensate that policyholder if specified uncertain future events called the insured events adversely affect the policyholder. So this entity, this issuer has agreed to compensate the policyholder if an occurrence of an event happened which is insured. So simple example, let us say motor insurance, car insurance. So in this case, the policyholder transfers the significant insurance risk if tomorrow this guy meets with an accident, hits the car, and damages some property, or hits an individual and the other party is injured. So this is the risk which is covered in this auto or your let's say the car insurance. So thereby meaning this contract meets the definition of insurance contract because the policyholder is passing on the significant insurance risk to the issuer of the contract, and the issuer of the contract has agreed to compensate the policyholder if that insured event, like the, let's say, accident in a car insurance, if that happens. So this is how the insurance contract is defined. And as I mentioned even earlier, the definition of insurance contract as given in this appendix applies to contract, not to an entity. This need not be an insurance company. It can be any company, any entity, even a manufacturing company also, if it has given this kind of a insurance. Okay, so this is one second. So 1 minute. So let me go back to the slide where we were on the scope. Why it is not going? Let us start. Okay, let me go back to the scope slide. Yeah. Yes. So what we said, so the first piece of the scope is insurance contract which have been issued by the entity. So if an entity has issued the insurance contract, they are within the scope of this standard. Second, reinsurance contracts. What is reinsurance contract is something which we will see immediately in the link. But let us understand there are two types of the insurance contract. Okay, let me explain this to you. What the scope or scoping of IFRS 17 says that the reinsurance contract which have been issued or reinsurance contract which an entity holds. So it's a simple thing. Let's continue the same example. That there is a policyholder. Policyholder has taken a policy from this insurer or the entity. Now, let us say, yes, they have taken the insurance or given the insurance to this policyholder, the risk appetite or the quantum of the coverage which they have given, they want to get it reinsured from some other insurance company also. That means what? If the claim happens, of course, the claim will be settled to this, but this insurance company, the original insurance company, will be able to claim a part of this as a reimbursement from the entity who have issued the insurance contract, which means effectively in that case, this entity is passing on a part of the business to another entity. So when you have a reinsurance contract, both the legs of the insurance contract are also within the scope of this standard. Thereby meaning the ones which reinsurance contract issued and the reinsurance contract held, both are within the scope of this standard. Now, if you try to contrast it here the insurance contract which is issued only, which is covered as a policy holder, the person who has taken the insurance policy, that person did not apply IFRS 17. But here this guy who has passed on the part of the business is effectively a policy holder for that reinsurance contract. Even that policy holder is covered. So reinsurance contract, both legs are covered within the scope of this standard. And this is what you will see it here when you go and look at the reinsurance contract. So this is I've kind of already explained to you what happens in a reinsurance contract. It is like this, that there is an original contract between this policyholder and this guy. This has, I think there's somebody is, yeah. Okay, so there is an underlying insurance contract. The policyholder has passed on the significant insurance risk. They paid the premium, and is there a way, Devdataji, if you can mute the people? There's some background noise which is coming.
Is it okay now?
Yeah, it is better. Yeah, thank you. Okay, so in case of an insurance contract, as a reinsurance contract, this is the policyholder. It has passed on the significant insurance risk. The insurance premium is also given by this guy, and this is the original leg of the contract. But then what happened? This entity which has issued the insurance contract to this policyholder, they enter into another contract with another reinsurer, and therefore there is a contract between them wherein this guy will pay premium, and the cedent, this entity who has passed on the business, they have the right to get reimbursed if the claims eventually gets paid to the original policyholder. So under IFRS 17, both these legs of the reinsurance contract gets covered. But in a original contract, this guy was not covered under IFRS 17. Only this was covered under IFRS 17. So this is what the scoping is. Now going back to this, the last leg of the insurance contract is, what is the fourth element of the, let me clear, if I can clear this one second. Yes, all, yeah. So if you look at the fourth leg, so what is covered? One is the insurance contract issued. When it comes to reinsurance, both the legs issued as well as ceded. And the fourth one is investment contracts. If an entity has issued an investment contracts coupled with the insurance, which means investment contract with discretionary participation features, and also topped it up with an insurance contract, which means in this case, there are two elements of the contract. One is the normal insurance contract plus the discretionary participation based investment contract. If you have something like this, then they are also covered within the scope of this standard. Net, what this slide tells you, that there are four legs, four types of contracts which are covered within the scope of this standard. This, and issued investment contract with discretionary participation feature. Let us see the link of that one. What do you mean by investment contracts with a discretionary participation feature? Now, this is also, if you see, it is a defined term in Appendix A to IFRS 17. It says these contracts, this insurance contract with discretion, as the word used, discretionary, not something which is a direct party. It is at the discretion. The participation or how much of the profit will be passed on to the policyholder is at the discretion of the insurer or the issuer of the contract. So these contracts are contracts under which the investor, that is the policyholder, receives an additional payment from the issuer. However, this additional payment, the quantum and the timing, how much and when will be paid by the issuer is something the issuer decides. This is the second point. However, the amount, the quantum of this or the timing when it will be paid, such additional sum is contractually at the discretion of the issuer. If you have such kind of a contracts, they are called investment contracts with discretionary participation features. So if you have you have issued this kind of a contract coupled with a normal insurance contract, which we have already seen the definition, then in that case, the entire contract is also within the scope of IFRS 17 accounting. And this is what it says here. Let me go back to the scope slide. So this is what is the four corners of what is covered within the scope of this standard. Then, as I already mentioned, the focus of this IFRS 17 is on the type of contract, that is the insurance contract, any of these types of contract, and not on the type of entities. So it is not purely insurance company. Even a manufacturer can also be governed by the requirements of IFRS 17 if this entity issues a contract which is of any of these four categories, then they are also equally covered within the scope of IFRS 17. Mind it also that the fact that an issuer of insurance contract is governed by IFRS 17 does not mean that they are not governed by other standards. They will still be governed by other standards also. So, for example, Ind AS 109 or IFRS 9, which deals with the financial instruments. So those will also be equally applicable. IFRS 17 would be the main standard which will drive their accounting for the insurance revenue and insurance contract related costs. Now the next question is, having understood what is scoped in, now what is scoped out, which means what type of contracts which look like a insurance contract, having seen the definition, but they are still scoped out, which means because there is a separate standard or there is a specific exclusion that they are not to be covered under IFRS 17. There are 5 of those. Let's look at it. Product warranties. So, for example, if we go and buy a washing machine in the market. Now, this washing machine comes with 2 types of warranties. Your standard warranty, 1 year, and then there is something called extended warranty, which you pay for it and you get coverage for additional period. So let's say if the warranty is 1 year standard manufacturing defect and 3 years additional extended warranty by paying 5,000 rupees more. Now, this extended warranty typically meets the definition of an insurance contract. But what the standard tells you that product warranties which are given by the manufacturer, dealer or retailers in connection with sale of goods or services, they are outside the scope of this standard. They are governed either by this standard warranty is covered under IAS 37 and this is covered under IFRS 15. Corresponding literature in India, we have Ind AS 37 and Ind AS 115. So these are outside the scope of product warranties are outside the scope of IFRS 17. Same way, residual value guarantee. They are within the scope of IFRS 16 or Ind AS 116. They are outside the scope of this. Same way, employers' assets and liabilities from employee benefits plan. They are within employee benefit standard. They are outside the scope of this standard. Then contingent consideration in a business combination. What this new stuff is all about. These things which we know by common sense. What is this contingent consideration in a business combination? Let me explain this concept that if you have something like this is covered under IFRS 3 or Ind AS 113 from an 103 in the Indian context. 103 or IFRS 3. What is contingent consideration? So, for example, let us say H Limited, a holding company, acquired control of the business of another company, S Limited. And for this acquisition of 100% business, let us say they pay, H Limited agreed to pay 100 crores purchase consideration. This is fine. This is your normal purchase consideration. But what is contingent consideration? Let us say contractually H and S agree that wherein H Limited tells this S Limited, okay, after the acquisition, let us say in the next year, if your turnover is more than 200 crores post acquisition, I will pay you additional 10 crore of purchase consideration. Now, you see here, this payout of 10 crore purchase consideration is contingent upon the 200 crore of the turnover being actually met in the future in the subsequent period, 1 year later. That is, so there is a contingency towards the payout of this 10 crores. This 10 crore is called contingent consideration under business combination. So if you have such kind of a contingent consideration, they are also outside the scope of IFRS 17. And I already told you, policyholder of an insurance contract is outside the scope of this standard. So insurance contract held by the policyholder is outside the scope of this standard, but excluding the reinsurance contract. In reinsurance contract, both the policyholder and the issuer of reinsurance contract both are covered, which we saw in the previous slide. And therefore, when it comes to the regular, leaving aside the reinsurance contract, all other insurance contracts, the policyholder is outside the scope of this standard. Now, so just to summarize what we have seen, the previous slide we saw 4 types of contracts which are within the scope. Then here we saw these 5 categories of contracts which are outside the scope. Now, in the next slide, we will look at 4 more types of contracts where there is an accounting policy choice, which means they can be covered under IFRS 17 also, or they may not be as per the choice opted by the entity. What are those? Let us see this in the next slide. So now you have 4 cases where you have accounting policy choices. The first thing is fixed fee contract, fixed fee service contract. So what happens in this case? Let's say you have a roadside assistance contract. You reach to an entity who is helping you with a roadside assistance. If tomorrow your car breaks down, so you have entered into a 1-year contract with this entity to say that, okay, if my car breaks down at any point in time in the next 12 months, you will help me in doing this roadside assistance. So what happens in this case? The entity which is giving these services may actually apply revenue accounting, IFRS 15 or Ind AS 115, revenue from contract with customers. If they choose, they may not apply this IFRS 17, rather they may apply IFRS 15, which is revenue recognition, subject to meeting certain conditions which are given in paragraph 8. Apart from that, there are, from a bank's perspective, generally, there are two types of contracts which can potentially be within IFRS 17, but as an accounting policy choice, these can be governed under IFRS 9 and not IFRS 17. So, for example, if you have loan contracts or the loan contracts with waiver on death. So if death happens, the outstanding loan gets completely liquidated. Or if you have credit card contracts with certain insurance coverage, those also subject to certain conditions, which we are not going into now. IFRS, these entities who have issued these type of contracts may decide as an accounting policy choice not to apply IFRS 17, but rather apply IFRS 9, which deals with financial instruments. They can choose so as by way of an accounting policy choice. And same way, the last of such accounting policy choice relates to what is called financial guarantee contracts. Now, the financial guarantee contracts, financial guarantee contracts are generally covered under IFRS 9, and therefore there is an accounting policy choice which an entity has. If an entity has issued a contract which is a financial guarantee contract, then in that case it may choose not to apply IFRS 17, rather continue to apply IFRS 9 dealing with financial instruments. So that is also possible. Okay, so this is what the scope in and scope out is all about. There are a couple of more slides which I have. Let me just conclude on that, and then we will look at any specific questions which we have. Now, this brings us to the last two subtopics, on the measurement models and the possible transition approach. So what are the various measurement models? As I alluded to in the past, okay, there are three measurement models which are contemplated under IFRS 17. These measurement models are, the first one is called building blocks approach, or what is called general measurement approach, which I already indicated, right? That in this approach, what happens in this? In this approach, what happens? I gave an example of how CSM is calculated, right? I told you CSM is your expected inflows, outflows, then the time value of money impact, and the risk adjustment, right? So this building block approach is, or the general measurement approach, this is the default model for all insurance contracts, but for contracts which are in the nature of participating contracts like ULIP. So if you have participating contracts like ULIP, they have to be covered in the third category, and we will deal with that. Okay, but for that, this general measurement model is the default model for all insurance contracts, and you have mandatory requirement to apply it. But if you have contract like ULIP, where you will be participating in the profits of the contract as a policyholder, then the third approach, variable fee approach model, will be applied. Okay, so this, the third one, as I said, is the variable fee approach. Now, this variable fee approach, I'll come back to on the second one, but let us look at this one. Let me clear this. So first is the building block approach, which is a default model and mandatory to be applied for all contracts other than these. So if you have participating business like a ULIP, in that case, this variable fee, VFA, it is VFA, not PA, VFA. VFA approach, this is a mandatory requirement if eligibility criteria is met, which means if you have issued a par product wherein you will allow the participation of those the policyholders, then you got to apply variable fee approach model only. It is a mandatory requirement. But if you leave aside these, then this GMM or general measurement model is the default model which you need to apply. Now, there is some concession given under this model, PAA. What is this? The premium allocation model is actually based on this model only. Even this VFA is also based on this model only. There are certain tweaks which are available here. Same way in this case, in the PAA or the premium allocation approach, it is very simple model to apply. So some simplifications are given here, and you cannot apply PAA to any and every contract. No, it is a simplified approach only for short duration insurance contracts, generally up to 12-month period. So if the insurance cover is up to 12-month period, you may decide not to apply this, rather you apply this model. But even this model is based on the GMM model, the general measurement model, or the building blocks BBA approach. This is also based on that. subject to certain simplifications which are there, and it is optional. And that's why we say default model mandatory. So an entity which has issued, let us say, a typical car insurance or a medical insurance for 1 year, they can apply because they fall into the short duration contract, this model. But this is an option. They may choose not to apply this. Rather, they apply the default model. And therefore, if you summarize it, in summary, what we can say, you look at it this way. If you have a par product, variable fee approach is a mandatory requirement. You got to apply it. But assuming you don't have the par product, then this is the default model. You always got to apply GMM model or the BBA approach. But if you have short duration contract, you have a choice to apply this simplified version and not apply this. These are the three models which this standard talks about. And the last bit of our discussion today is the possible transition approaches, that when you are moving from your existing GAAP, which is your IFRS 4 accounting, to IFRS 17 world, what are the transition approaches? How do you transition from your existing world to the new world? Is this, there are three possible transition approaches, and you have to look at very carefully. The first one is fully retrospective approach, FRA. Fully retrospective approach assumes that you have always been applying IFRS from day one. And therefore, this model also represents a default transition approach. So the standard requires you by default to use this fully retrospective approach as if IFRS 17 was always applied in your business. So this fully retrospective approach must be applied unless impracticable to apply. Why impracticable to apply? Because the information which are required for applying this fully retrospective approach may not be available. If that be the case, it may be impracticable to apply. If that be the case, the standard gives you another choice. But otherwise, the requirement in the standard is that if you have information available, this is the default model. You have to apply this. You can't go to the, out of the three approaches, you can't go to the other two models. Recommendation is by default, you should apply this. But assuming that you don't have sufficient information, it is not practicable to apply this, then you have another choice. So if impracticable, the next step is you apply not fully retrospective, but what is called modified retrospective approach, MRA. Now, this modified retrospective approach is similar to this, but it gives you certain relaxations in terms of what you can, even if the information is not there, how can you apply this? You can apply with the modification. And therefore, in this case, even hindsight is also allowed. So you can think through at a later point in time. That's what exactly it says here. It is similar. This modified retrospective is similar to fully retrospective, but with prescribed modifications that are permitted. So it makes the life easy for transition. Some relaxations are given here. And use of hindsight is permitted under this approach. You can have an after effect, or if you have information coming from hindsight, even that also you can apply. So these are the two. First is your fully retrospective, failing which you apply modified retrospective. And if for some reason even this cannot be applied, then the third approach is what is called fair value approach. So in this fair value approach, this is how you compute CSM. CSM on the date of transition will be fair value of the liabilities minus fulfillment cash flow. Now let me just take you through one last slide wherein I will just give you a pictorial representation of how CSM is computed under the GMM model. So basically, this is what your transition approach is. Let me just take you through 1 second. Let me go to that slide. Yes, if you see here, this is how, if you recall what I mentioned, that CSM. So when you are calculating CSM, CSM is expected inflows plus minus expected outflows, then the effect of time value of money, and the risk adjustment. This is what is being mentioned here. So if you look at the GMM model or the building block model, assume that an entity assumed that they will have an inflow of 100 rupees. So estimated inflow for the group of contracts is 100 rupees. And then if they also estimate that my outflow of this group will be 30 rupees. So what is your net cash flows which are expected? 100 minus 30, which is 70. Now, this need to be discounted. So the discounting, because insurance contracts are long period contracts, discounting will increase these net amount from 70 to 80 if the discounting effect is 10 rupees. But then, as I told you, there has to be a risk adjustment which has to be consciously factored in. So if your risk adjustment is determined by the entity to be 20, then the residual leftover is your CSM. What is it? Let me clear this. You'll get it. 100 minus 30 plus 10 minus 20. So 100 minus 30 plus 10 minus 20. This works out to be 60. 100 minus this 70 plus this 80 minus 20, 60. Now this 60 is nothing but your unrealized profit on day one called CSM, contractual service margin. That's what I've already told you. CSM is the initial recognition is a liability. And therefore, this needs to be released over the period when you are providing your insurance coverage or insurance services. That's pretty much I wanted to cover from my perspective. And now I hand it back to the organizers to see in case anything else which we need to cover. Thank you. Thank you very much.
Absolutely, this is a mesmerizing session, sir. I'm a great honor. I think it's a privilege for us also to listen to your such a presentations. In fact, every time I was looking for that, maybe every slide, maybe another session like that, because the way you are navigating many questions, maybe already put. I request our Devabroto, the questions which has been already put into the chat box, kindly repeat, and so that our honorable speaker can delve on the issues. Devabroto.
No, I see there are certain questions. I can see myself here. So perhaps I can take it because I can then maneuver it the way. Okay. So some of the questions which I see, one is that what are the essential differences between IFRS 4 and 17? Alikji. So, sir, this is a fundamentally different kind of accounting literature. So if you were to compare them, I think it will not be fair to really compare both of them. There is a significant differences which are there between both of them. So you can understand, as I already mentioned, IFRS 4 was more focusing on giving disclosures by following your national or your country specific accounting related to insurance contract without giving specific mandates of what you need to do. So therefore, there is a substantial difference between both of them, and it will be perhaps beyond the scope of our discussion today to delve over it. If we have to go, I think it will take sessions to in fact talk about that. Shall be great if a correlation of IFRS 17 with actuarial science can be discussed. Okay, so as I mentioned, sir, so actuarial science is where the last slide which I showed you, the estimation of cash flows, estimation of your discounting, estimation of your risk adjustment, all of these is something which the actuarial world will do. And that's where, as I said, that there is a lot of interface between the accounting fraternity and the actuarial world. The reason is very simple, because the way this IFRS 17 requires you to implement those the requirement of measurement. This is something which has to be hand in hand done by the when I say it has to be done by actuaries, yes, actuaries are the pivotal set of people who will be doing these calculations hands-on. But then as an accountant, the responsibility for us would lie in understanding those numbers. So we as an accountant should understand how the numbers move. But the calculation bit of it is something which will come from the actuarial world. That's the limited point, I just wanted to leave you with this thought. Unekalji, okay. Is IFRS 17 about revenue recognition and cover both life and non-life? Yes, sir. Ranganathanji, yes. It is revenue recognition. It has a lot of other aspects and yes, it does cover both life and non-life. So I'll give you some example, which kind of I have indicated. Good that you have picked up this question. Now, when I said non-life is the example which I gave, let's say the car insurance or a mediclaim which is issued for 1 year, or your bike insurance like that, or travel insurance for let's say a 15 days trip you are going for US and you take overseas travel. Those are non-life, and for those non-life or short duration contract, you may apply the second model which we looked at. PAA is what you can apply. And in terms of the life, yes, the first model, the GMM model, which we talked about, is something which will be relevant. So to your question, whether it applies to both life and non-life, certainly it applies to both. Can we broadly
the next
say?
question is,
Yeah,
how
please
this
go ahead.
IFRS will impact on insurance companies on the way of closure, sir?
Significantly way of closure, because as you can see, there are, I mean, obviously we have not gone into that level of details. There is a humongous requirement and back-end calculations will be required. And that back-end calculation humanly, manually is impossible. So there has to be a lot of technology intervention has to be there, wherein the actuarial model and the accounting model in terms of the GL accounting, they need to talk to each other. Okay, so that will put a humongous amount of pressure on the close deadlines, right? But this is where the challenge is, and therefore, what we say that, I can show and maybe share my experience. What we did in our company, as I said, we have already applied IFRS 17 globally. We started the preparation for IFRS 17. Believe me, 2 years before the standard was about to start, which means 1st of January 2023 is the standard which was supposed to be applied. We started the preparation 2 years back. Now, to your question, will it impact accounting? Will it impact month close, your day-to-day work? Certainly it will, and in a big way. Okay, you will have a lot of technology intervention required. You will have a lot of, and that's where Chitranjanji was alluding, the cost benefit analysis is there. You will have to spend perhaps a significant portion, okay, of your budget on building new technology platforms, which will help you that you do the reporting. And we have not even touched about disclosure. The disclosure requirements are really onerous, and therefore to get to those kind of disclosures which are required in the standard, you cannot have manual thing. So therefore, the system should be competent and enough to give you all of those reports, and therefore it will significantly impact the business the way it is being done currently. Yes, sir. If you have any question, please.
Yeah. The next question by Mr. CMA Ram Mohan Bhave. He has said that, can we broadly say that it moves from the cash basis to mercantile?
Certainly, sir. Certainly. Not mercantile. I would say cash basis to the way your services are being like matching of what we do, revenue recognition. To that extent, yes, you can say that mercantile, but yes, it will certainly move away from the cash basis.
Well, another CMA BK Unhelkar, he has said that owing to resistance for change to what our financials look like today, did you experience any conflicts between profession of actuaries and accountants, especially in the light of broad expectations from management and the shareholders?
So, sir, I would say this way. Okay. Oh, I completely understand what you are saying, resistance to change. Obviously, it is a but natural human tendency. Okay. But then let us also look at that it was not a simple accounting standard to be implemented. Okay. And you could have seen, even after the standard was issued, it took almost 2 years to discuss the implementation issues after the final version has come out. So yes, there were issues genuinely. There were certain part of resistance also, but to my mind, perhaps to cater to the entire insurance industry per se, it required a lot of deliberation. I mean, I'll not be surprised if I'm not wrong. IASB has conducted more than 1,000 stakeholders meetings during this period to come up, and it is, if I recollect the number, I hope I'm correct, but it is close to 1,000 meetings with various stakeholders. That itself should be able to give you a sense of how much, intricate the stakeholders' involvement was in finally coming out with this standard. But of course, and to your other point, whether we like it or not, two different professions may look at things differently. But as I mentioned, this standard is bound to be a failure from an implementation perspective if you do not have that kind of a close hand in hand together. Okay, so we like it or not, the fact of the matter is that this requires a close coordination go forward if you were to implement this standard. I will leave it at that rather than commenting on the specific question which you have. Okay.
Well, CMA BK Unhelkar has asked that as we experience in life insurance industry, determination of embedded
Yes.
value in the domain of actuaries, not accountants. IFRS
Yes.
17 seems to be an area of conflict between the actuaries and accountants as to who would be the mainly responsible for the implementation of IFRS 17. Your
Yes.
thoughts thereon, and especially in the US scenario, wherefore you are giving your professional services.
Okay, so I'm not giving professional services there. Okay, so I'm working as I'm a salaried person. I'm working as a regional head finance for a US company. So I'm not giving professional opinion there. But yes, what I'm saying, sir, embedded value, yes, it is in the domain of the actuaries, and it will continue to remain so. Now, to your point, conflict of interest, it cannot be. See, any big change when it happens, it requires management intervention at the top. So how you set the tone at the top will determine. I get where are you coming from, but multiple teams, the way IFRS 17 implementation will work, there has to be a multi-dimension, multi-department team which need to work together along with the auditors. Let me also warn you, the auditors cannot come in the last stage. As you are progressing through your implementation, you have to onboard your auditors also gradually to say, this is what you are progressing. This is what you are trying to build your logic, because it cannot happen that you build the logic, you build your system, and then one fine day auditor comes and say, this is not something which you was expecting. There'll be a problem. And therefore, multiple stakeholders will be there. But to my mind, the conflict is something which has to be taken care of by setting the right set of tone at the top. And that is what we have done it. Okay, in our company, the mandate and the facilitation. Mandate means it is not that you have to control individual groups. Once the messaging is loud and clear that this is a requirement, you guys have to work together as a team, that happens. Without a doubt, it does. Yes, sir.
Next question, sir. CMA Rahul R. He has said that what is the ideal level of cohorts groups which should be kept by insurers considering onerosity impact? Is
Wonderful
there any
question.
guidance?
Wonderful question, sir. So we have not touched about it, but let me tell you, it looks like Rahulji is aware of this standard. So let me give you, sir. Cohort, the maximum cohort is 1 year in the standard. IFRS 17 gives you a requirement that the contracts in a particular group cannot be more than 1 year apart. That's the requirement under the standard, but you are free to choose a shorter cohort. Now, how many people will be going for shorter cohort and all? It's again specific to that individual company, but what the standard tells you that you have a leeway up to 1 year, you can have the annual cohort.
But CMA Ramon Bhave, sir, he has asked that what are the major advantages of adopting IFRS 17?
We have already covered, sir. Advantages is basically the transparency, and then in terms of your better information would be available to stakeholders. Those are the one which was already there on the slide. Yeah.
He has also asked that what type of manipulation or wrong presentation will get avoided by IFRS 17?
Sir, when you see the presentation and disclosure requirement, everything need to be reconciled. So whatever you are showing, that all need to be disclosed by way of a reconciliation. And if we need disclosure, you need 2 days, not 2 hours. That is the level of disclosure which are required. So, I was fortunate enough that from ICI's perspective, we had joint session by IRDI, the Actuaries Institute and the ICI. multiple such sessions. So there, the disclosure was devoted for almost 6 hour session by so in terms of disclosure, yes, it'll be a lot of disclosure required. And in terms of specifically what I would say, whatever you are presenting on the main financial statement has to be reconciled, because the disclosure requirement are such that they should tie and talk to each other. That's the way it is.
CMA TS Rao has asked that how discounting can increase under CSM.
Okay. Sir, the way it happens, TS, let me just give one thing. On the slide itself, I'll write 1 minute. Okay, so I think it is not there. Okay, let me just explain because I can't write it here now. This is very simple thing, sir. Let us say the same example which I said, 100 rupees is my inflow, 30 rupees my expected outflow. My expected outflow may happen in next 10 years. So the 30 will happen in next 10 years. And therefore, the discounted value of the outflow will be lesser than 30. And that's why the discounting will give you a better positive number. Yes, sir. Continue. I think I can't hear the audio right now.
Aditi, you are,
Oh, sorry, sir. Yeah. Will IFRS 13 cover fair value measurements under the IFRS 17, or it has its own principles?
No, sir. So the way it is, generally, if you look at the general guidance, whenever the IFRS and the Ind AS world talks about measurement of fair value, measurement, how you do will be governed by 113. But when to do will be governed by individual standards. So yes, once that IFRS 17 tells you fair value has to be done, but the guidance you have to follow from 113. Nice question.
Mr. CMA Ranganathan, he has asked that what about regulators' role like IRDA in the application of the standards?
Big role. So that's why it is right now we will see a lot of intervention from the regulators, and obviously they will have a big impact in the eventual implementation and what gets implemented, what doesn't get implemented also. So for example, do we have any caveats, or rather the carve-outs from the IFRS world in the Indian context is something we need to keep an eye on.
Well, then is US GAAP for insurance contract different from IFRS 17?
Yeah, I think so, but from our company perspective, though we are working in US, but our reporting framework in US is IFRS. So we have worked on IFRS 17 world, not something which is based on the US GAAP on the IFRS accounting. But I think there is a difference between both the accounting framework.
Yeah. Well, the last question for today, sir. CMA Ranganathan has asked, do registered valuers have a role to play in the fair value approach?
Yes, certainly, because the registered valuer themselves, to my mind, is the ones, they are the critical professionals who do the fair valuation or help in doing fair valuation. So certainly that goes without saying that they will have their own say as we go through the implementation of this standard. Yes.
Okay, so with that, over to you, Devabroto, for comparing.
Sir, thank you indeed. It was a great session today being heard from such a learned professional. I hope the members are also benefited and they have enjoyed this session. I would request Aditi madam to give the vote of thanks for today's session.
Before Aditi comes into picture, I just like to mention here to our honorable speaker today. In fact, many esteemed and learned people, professionals joined in this today's platform, and you will be very happy that one of our Pandit in IFRS, he is also here today. Ramon Bhave sir.
Yes, sir. I know him.
He has taken many sessions in our institute. He's also a chartered accountant, cost accountant, company secretary, and everything.
Right, sir.
And the most important thing that he has raised many questions, and I was really feeling, it is a matter of great, learning for us, that you see that there is no end to learning. So today your session is such a session. I think many of the people, those IFRS 17 has become one of the very crucial in this insurance sector, and the actuarial, as you have rightly mentioned, that the conflict of actuaries and IFRS, there's no, ultimately at the end of this, there will be synergy. There will be definitely the, everything will come, because everything is there only to take this insurance sector in a great, way, so that the country reap the benefit of the insurance sectors at large. Therefore, today's session, and we look forward for further sessions in your available time, sir, because you have already stolen the heart of the thousands of peoples. So we wish you all the best, and in future we want to again meet with you and have a program. Even I look forward to have your physical presence, especially in some of the programs of our institute. Thank you. Over to you.
Certainly, sir. Certainly, sir. Thank you very much. Thank you.
Aditi madam, please, for the vote of thanks.
Well, with that, we have come to the end of this session. At the outset, I would like to thank CMA Anjani Kumar Khetan, our guest speaker, for his exhaustive presentation and the way he has walked us from the inception of IFRS 17 to its objectives, to its scopes, and after this fantastic and successful question and answer session, I would like to thank CMA Ashwinji Dalwadi, our president, ICMAI, CMA BB Nayak, the vice president, ICMAI, and CMA Chittaranjan Chattopadhyay, our very own, he's the chairman of BFSIB and IASB. And the BFSIB team board members for their continuous support and encouragement. And I would also like to thank our CMA Dibyendu Roy. He is our HOD and additional director and the secretary of BFSIB for his encouragement and support for so that we can work under this BFSIB. Our team members, Mr. Shantanu Pradhan, Mr. Devbroto Dash, Indrakshi Madam, and Mr. Rahul Arya for holding their hands and working with all of us. And I would also, at the last but not the least, I would also thank the CP department and the IT department for the support, without whose support this webinar would not have been possible. With that, we have come to the closure of this session, but looking forward for many more such webinars to make our insurance month a successful one. Please stay tuned for our 21st February program on insurance, and it would be a gala event. It would be in a hybrid mode. So please be with us. Over to you, Devbroto.
Thank you.
Thank you,
Thank you.
madam,
Thank you.
for such a wonderful conclusion. Thank you, all the members present here. Hope you have enjoyed the session. It has been really a great learning for us. Sir, we look forward from you in coming days. Thank you, sir.
Certainly. Thank you. Thank you. Thank you. Bye,
Thank
everyone.
you.
Bye.
Thank you.
Bye.
Thank you.
Bye.
Bye, sir.
Thank you.